Silver hit 78.60 this morning. Physical premiums spiked $14 over spot. Dealers went to allocation mode within 3 hours. This isn't normal price discovery. The paper market just printed a volume spike that triggered circuit breakers on 2 exchanges. Venezuela defaulted on gold-backed debt 4 hours ago. The Fed dot plot leaked early showing emergency cut scenarios. I'm watching real-time disconnection between what COMEX says silver costs and what you actually pay to hold it. The spread hasn't been this wide since March 2020. That should terrify you. Let me walk you through the last 72 hours because this didn't start this morning. Monday, 11:47 p.m. Eastern, Venezuela's central bank missed a $340 million payment on gold collateralized bonds, not regular bonds, gold-backed paper, the kind institutional investors thought was safe. By Tuesday morning, 3 European banks holding Venezuelan gold certificates filed emergency liquidation notices. They needed to sell the physical gold backing those bonds. Except there's a problem. The gold wasn't in Venezuela, it was in London vaults, and it's been hypothecated 5 times over. That's when silver started moving. Tuesday, 2:15 a.m. Shanghai Gold Exchange physical premiums jumped $40 per ounce overnight. By 9:30 a.m. New York Open, silver futures on COMEX were already up 4.7%. But here's what I noticed immediately. Physical dealers weren't updating their websites. I called 4 major bullion dealers before noon. 2 had suspended online ordering. 1 went to phone orders only. The 4th told me their supplier allocation was cut by 60% effective immediately. This is supply shock mechanics in real time. Then Wednesday morning, the Fed leak happened. Bloomberg reported anonymous Fed sources discussing emergency rate cut scenarios for Q2 2026. Not scheduled cuts, emergency cuts, the kind they only discuss when something's breaking. Within 90 minutes, silver futures added another $3.80. Gold jumped $127, but the real action was in physical markets. By Wednesday afternoon, I'm seeing reports from Europe of month-long delays on silver bar deliveries. Refiners in Switzerland telling distributors they're prioritizing industrial contracts over retail. That means you and I are at the back of the line. And this morning, that paper physical spread I mentioned? $14. You can sell silver on COMEX for 70, 80, or 60. But try buying a physical ounce. You're paying 92.60 if you can even find it. That's not a market, that's a mirage. Now, let me explain what's actually happening beneath the surface because the mainstream financial press won't tell you this. The Venezuela default isn't about Venezuela. It's about rehypothecation. When Venezuela issued those gold-backed bonds, they pledged physical gold as collateral. That gold was deposited in London vaults. But here's the trick. Those vaults then leased that same gold to bullion banks. Those bullion banks sold futures contracts against that gold. Other institutions used those futures as collateral for different trades. 1 physical bar backing 5 different paper claims. This works perfectly fine until someone demands physical delivery. Venezuela defaulted. The bondholder said, "Give us the gold." The vault said, "We leased it." The bullion bank said, "We sold futures against it." And suddenly everyone realized the same ounce of gold was promised to 5 different entities. This is the paper market's original sin. It assumes nobody will ever want the physical metal at the same time. But silver's worse. Way worse. Industrial demand for silver hit record highs in 2025. Solar panels, electric vehicles, 5G infrastructure, defense manufacturing. These aren't speculators. These are companies that need physical metal to build products. They can't take COMEX paper and turn it into a solar panel. They need bars delivered to factories. So industrial users started demanding physical delivery months ago. That steadily drained available supply. Then investment demand increased because smart money saw inflation wasn't dead. Central banks talked about rate cuts, while M2 money supply kept expanding. That brought investors into silver. They also wanted physical, not paper. Now you have industrial users competing with investors, competing with nations trying to repatriate gold reserves, all demanding physical delivery from a system that was never designed to deliver at scale. The COMEX silver warehouse stocks dropped 37% in the last 4 months. That's 140 million ounces that left the system. And here's the nuclear detail nobody's discussing. Bank of America has a short position in silver derivatives equal to approximately 800 million ounces. That's nearly 1 full year of global silver mine production. If they're forced to cover that position by delivering physical metal, they can't. The metal doesn't exist in available inventory. This is why premiums exploded. This is why dealers went to allocation. The paper price said $78. The physical reality said, there isn't enough metal at any price under $90 to satisfy current demand. We're watching the paper market lose its ability to set the real price, and when that perception breaks completely, when enough people realize the COMEX price is fiction, that's when price discovery goes vertical. Not because of speculation, because of physics. You can print infinite paper claims. You cannot print silver bars. Let me show you what the institutions are doing while retail investors are still checking Yahoo Finance for prices. Last Friday, JP Morgan took delivery of 2.4 million ounces of physical silver from COMEX warehouses. They didn't buy paper contracts, they demanded physical metal and moved it to non-COMEX storage. This is the fourth consecutive month JP Morgan has drained physical silver from the exchange system. They're not trading, they're hoarding. Simultaneously, Goldman Sachs published a research note calling silver overvalued and recommending clients reduce exposure. You see the game? Public research says sell. Private trading desk demands physical delivery. They're telling you to sell so they can accumulate the physical metal you're dumping. Then there's the central bank behavior. Poland's central bank announced last week they're increasing gold reserves by 12%. Singapore didn't announce anything, but import data shows they brought in 47 tons of gold in February alone. That's a 340% increase from the previous February. These aren't decorative purchases. Central banks are moving to hard assets while their own currencies are being debased through rate cuts and fiscal expansion. And the timing matters. They're doing this before the Fed pivots to cuts, not after. They know something we're supposed to ignore. I'm also seeing pension funds quietly shift allocations. CalPERS, one of the largest public pension funds in America, increased precious metals allocation from 0.8% to 2.1% in their last quarterly filing. That's a 162% increase in dollar terms. These are the institutions managing retirement money for millions of people. They're not speculating, they're protecting. Then we have the mining companies. 3 major silver producers suspended forward sales programs in the last 6 weeks. These are contracts where miners agree to sell future production at fixed prices. Why would they cancel those contracts? Because they believe prices are going much higher and they don't want to be locked into selling silver at $70 when the market price might be $140. Even the options market is screaming warnings. Silver call options with $100 and $125 strike prices for June 2026 expiration saw a volume increase 890% this week. Institutional traders are placing massive bets that silver will double from here in the next few months. This isn't retail FOMO. This is institutional positioning for a currency crisis. They're not buying silver because they love shiny objects. They're buying silver because they're losing faith in the paper system's ability to function. I've seen this pattern before. Not exactly like this, but close enough to recognize the sequence. March 2020. Pandemic lockdowns triggered a liquidity crisis. Gold and silver prices spiked, then crashed as institutions sold anything liquid to cover margin calls. But within 6 weeks, premiums on physical metal went to 8-10 over spot. Dealers couldn't keep inventory. Mints suspended production. The paper price said $24. The physical market said $34 if you could find it. The difference? That was a liquidity crisis that resolved in months. This is a structural crisis in the monetary system itself. Go back further, 2011, silver hit $49.80 on April 25th. Then COMEX raised margin requirements 5 times in 8 days. They made it too expensive to hold leveraged positions. Price crashed to $35 within 2 weeks. But here's what people forget. Physical premiums stayed elevated for 8 months. The paper market could be manipulated through margin changes. The physical market knew the metal was scarce. Even further back, 1979 to 1980, silver went from $6 to $50 in a year. The Hunt brothers tried to corner the market, but the real driver was inflation panic and currency debasement. Paul Volcker raised interest rates to 20% to kill inflation. It worked, but it also triggered a recession that lasted years. Here's the pattern. Every time faith in currency systems weakens, precious metals surge. Every time central banks try to maintain control, they break something else. In 1980, they broke the economy with rate hikes. In 2020, they broke the bond market with QE infinity. Now in 2026, they're trying to cut rates while inflation's still above target. They're going to break the currency itself. And silver's the canary in the coal mine. It always moves before gold goes parabolic. It's more volatile, more industrial, more sensitive to supply shocks. When silver goes vertical like this, gold follows with institutional money. Then currencies start cracking. Then sovereign debt markets freeze. Then we're in full crisis mode. We're in the early innings of this pattern repeating, and it's moving faster than previous cycles. So what happens next? Let me give you the scenario analysis. Scenario 1, controlled descent. The Fed executes rate cuts slowly. Venezuela's default stays contained. Physical premiums compress back to normal levels. Silver consolidates between $70 and $85 for months. This is the optimistic case, probability, maybe 20%, because the structural problems don't go away. Industrial demand doesn't decrease. Paper market over-leverage doesn't fix itself. This just delays the real crisis. Scenario 2. Accelerated crisis. More sovereign debt issues emerge. Another country defaults or devalues. Physical supply gets tighter. COMEX warehouse stocks drop another 30%. Paper physical spread widens to $20, $30. At that point, trust in paper pricing breaks completely. People stop looking at spot prices and only care about physical availability. This is where silver could hit $150, $200 because it's not about speculation anymore. It's about getting your hands on real metal before the system locks up completely. Probability? I'd say 50%. Scenario 3, system break. This is the black swan scenario. A major bullion bank fails to deliver on physical contracts. COMEX changes rules mid-crisis to allow cash settlement instead of physical delivery. That's when trust evaporates entirely. Silver price becomes meaningless because there's no agreement on value. Some people will pay $500 an ounce for physical. Paper traders might see prices collapse because nobody trusts the contracts anymore. This would trigger investigations, lawsuits, potential exchange shutdowns. Probability? Maybe 30%, but increasing daily. Here's what I know for certain. The current system of paper price discovery backed by fractional physical reserves cannot survive unlimited physical demand. It's mathematically impossible. And we're approaching that limit right now. Industrial users need 750 million ounces per year minimum. Investment demand's running at 200 million ounces annually. Mine production is only 850 million ounces. There's almost no buffer. If central banks or sovereign wealth funds decide to add just 100 million ounces to reserves, the market breaks immediately. And with Venezuela defaulting on gold-backed debt, other nations are watching. They're realizing that paper promises backed by metal that doesn't exist are worthless, so they'll demand physical repatriation. Germany, Italy, Netherlands, they all have gold stored in New York and London. If they want it back simultaneously, the system cannot deliver. Silver's the warning shot. The real battle's about trust in the entire financial system. I'm not telling you what to do with your money. I'm showing you what's happening in real time while most people are distracted by headlines. Silver at $78.60 with $14 physical premiums isn't a bull market. It's a warning signal. The paper system's losing control, the physical market's taking over, and when that transition completes, prices won't be set by traders in New York. They'll be set by whoever has metal and whoever needs it desperately. Watch the premiums. Watch dealer inventories. Watch delivery delays. Those are the real indicators, not the COMEX price. This Venezuela default? It's not the cause. It's the trigger. The cause is decades of paper leverage built on fractional reserves and central bank currency debasement. That structure was always going to fail. We're just watching it happen now. Stay sharp. Watch the physical market, not the paper price. And understand that what you're seeing in silver is a preview of what's coming to the broader financial system. The disconnect between paper and reality can only last so long. We're watching the clock run out.